Good evening, ETF fans. This is Alex Shepard with ETF Action, and for today's daily video insight on the 9th of September 2024, I want to briefly look at valuation ratios and just take a quick look at the S&P 500 and where we currently sit after a recent surge in performance over the past year. So with that being said, we are in the system, and what I'm going to do is I'm going to move from the ETF dashboards to the databases to ETFs. Our screener here sorts all of the ETFs in the US listed market from largest AUM to smallest. So you'll see SPY at the top of the list, the Spider S&P 500 ETF Trust. I'll click into that, SPY. Just like when you look at any ETF on our platform, if you select into it, you can look through all of the data from an overview perspective, AUM and flows, performance, risk, distributions, composition, fundamentals, technicals, holdings, and tools and reports. Now, today, I just want to look at performance to start. And what we'll do is we'll just take a look. This is the 1-year chart. This is a pretty good looking chart. You made market bottoms in October. It's been a pretty steady up and to the right chart over the last year with a few pullbacks. And I will make note of that. It is common for markets to have pullbacks on an annual basis of 5%. 10% happens less frequently, but still very common. And the bigger ones, 20% or more, they do happen again less frequently. But I mean, these are opportunities, especially over the last several decades. You've seen markets continue to make their way up and to the right on the chart and taking opportunities for long-term investors to buy in when there are market dips. You can see, for example, after the market bottomed in October, I mean, we've had a great last 12 months. But you look in the spring, you even saw a pullback from 17.5% down to 11%. So we saw a 5% pullback in April. Now, if you march forward into the summer, we saw a similar pullback from S&P 500 up 27% to up only 16%. That was from July to August. So another pretty strong pullback there. We've recovered most of those losses and kind of treading water a little bit. And more recently in September, we've seen another decline from 27% down to 21% as of the close on Friday. Now, if you extend this chart out, we saw the markets come down pretty positive over the last couple of years, and then you're starting to see some little plateauing happening again. And I think a big part of that is folks are worried about where the economy sits, with a lot of ambiguity up in the air with the upcoming election. The Fed is sitting at 5.25% for their target rate. The futures market is projecting them to cut, but we don't know necessarily at what level they are going to cut to still. So that has folks concerned. Inflation has been coming down, but the labor market is showing cracks too. We have seen data come in below expectations on a number of data points. So recession talk is in the air again. That sometimes can be manifested just by having a conversation about it itself. But that being said, that has got some folks spooked, and we've seen some rotation out of some of the higher growth stock names from earlier this year with the AI craze into some of the defensive sectors. Now, from a valuation standpoint, let's take a look at that. We'll slide over to the fundamentals frame here. And currently the S&P 500 on a trailing price to earnings basis is trading at a 25.4 handle. Elevated from years previously, certainly. You can see on the next 12 months price to earnings is only at 21. But let's look at that over time. And to do that, we are going to look at tools and reports, historical data. What this tool does is it pulls in all the historical data points that we have on our system, but just for one fund over time. It has pulled in price and return as a default, but what I want to go to is equity characteristics, and specifically within equity characteristics, trailing price to earnings ratio. I'll open this chart up. It goes to column, but I'm going to switch it to line. And let's look at the last 10 years. So based on the current holdings or the portfolio itself through time, you can see the S&P 500 was trading 10 years ago at a 17 handle. and today it's trading at a 25 handle. Now we have seen growth in earnings over this time period, but we've also seen, based on this chart, the willingness of investors to pay up for those earnings. We've seen that in the S&P 500, but we've seen it in a number of other places. So just to give you an example, right now we're looking at 25.44. We peaked out at 26 in August. People are paying similar multiples on the S&P 500, but this is back during COVID when interest rates were dropped completely to zero. Right now, target rate for the Fed, as we mentioned earlier, is at 5.25. So the cost of capital is much higher, and that's important because long duration assets, such as long dated treasuries or companies that have the majority of their valuation based on growth and not current cash flow, i.e. the tech sector, those tend to do better in lower interest rate environments because the cost of capital is cheaper. It can fund and capitalize that growth. Now, when we're trading a similar handle when interest rates are at 5.25, whereas interest rates were zero here, it tells me that valuations, people are willing to pay up for those tech earnings despite the cost of capital being higher, which sometimes can lead to overvaluation. Now, part of this has to do with the makeup of the S&P 500, and I do want to touch on that before we end the video for this evening, but the S&P 500 has slowly changed in composition over the years. The tech sector has continued to increase its share of the S&P 500 makeup. And to show you that, what I can do is I can change this from equity characteristics to equity sector. And the data option I will choose is the tech sector, which I can find infotech. Currently, the tech sector is at 30%. That is 30% of the makeup of the S&P 500 is tech. Let's look at the last 10 years. 10 years ago, it was under 20%. It was at 19%. We've seen that can steadily increase. It actually topped 32% at one point earlier this year. So the exposure of the tech sector within the S&P 500 has grown 150% or 50% in growth, but it's gone from 19 to 30%. That's a big change over the last 10 years, and that continues to show that the strength of these large tech companies are gaining revenues and poaching revenues, almost stealing revenues as they continue to enhance other sectors of the market. What does that mean from a valuation standpoint? The tech sector, because it naturally has a higher valuation multiple because it is a long duration asset, and typically people have continued to pay higher premiums or higher multiples on the tech sector, that extra weighting in the S&P 500 is continuing to bump the SPY valuation multiple up as well. Now, what does that mean for today and going forward? Perhaps investors are pricing in the expectation of the Fed cutting rates soon. There are the futures market is currently projecting multiple cuts before the end of the year, and that could show why there is a surge in the valuation ratio of the S&P 500 in the recent performance. However, if those don't come to fruition, if we do see some of these unexpected, ambiguous things on the horizon, such as the result of the election or geographical events, we could see things turn a little bit negative. We want to make sure that inflation data keeps coming down. If we see a pause in that, that could trigger the Fed to not necessarily lower as much as we expect. And the consumer, which has continued to be very strong and uphold the economy, when we start seeing cost of capital pipeline, and that flows through the pipeline and hits the end consumer, and we start to see purchasing behavior change, that can spook folks, and that can very quickly change the dynamic of the marketplace. So we just want you to be aware of where valuation ratios are despite elevated Fed rates, and take note of where the gains have been this year, over the last year, and if you have any questions whatsoever, reach out to team@etfaction.com. Again, None of the securities we talked about today is neither a buy nor sell recommendation by myself or anyone at the firm. Please talk to a financial professional if you need to make an investment decision. Everyone have a great evening. Talk to you soon.